Hi, accounting students. Welcome to your first e-lecture. And remember, I want you to watch this prior to coming to class on your A day versus B day. So these lectures can also be found in a PowerPoint copy in my courses. So you'll want to potentially print that out or use that as a guide so that you can make notes along the way. So let's get started, and I'm going to turn on the slideshow. So a couple things about these slides that you'll see in every chapter. I always have these learning goals that are, oh, I hate red. All right, let's see if I can change my pen to a different color because red is yucky. Better. Learning goals, which, if you want to ask me as we get closer to the exam, hey, what's on the exam? You can always come back to these learning goals. This is what I plan to test you on. So it's a good way to check in with yourself. There's also key terms. About 2 years ago, one of my students said it would be really helpful if we could have a list of the key terms each chapter. So that's what this is. And you'll find it at the beginning of each lecture. So let's get started. What is accounting? Why in the world do you have to take this, right? Let me be clear. This is not a check the box type of class that we just make you take to make sure that you've got what it takes to be in the business college. This class is to help you succeed, whether you decide to open your own business, whether you decide to work for a large company, whether you decide to work for a not-for-profit, or even just for your own personal investing. You need to understand a bit about accounting because it's the language of business. Accounting is what helps us understand what's happening inside a business. Is it profitable? Is it not profitable? Does it have enough to pay its bills? Inside accounting, we've got two main types of accounting. We have managerial and we have financial. So managerial, I like to call that the wild, wild west of accounting. That's what companies use internally. And it can be principles based, but really the company defines it. It's how they want to look at themselves. So for example, inside Starbucks, they might decide they want to understand how many lattes are selling versus cappuccinos. That's managerial. It's not what we're doing this semester. Instead, we're doing financial. And financial is what companies use to tell the rest of the world, the people outside their company, how they're doing. It's very principles-based, but there are a lot of specific rules. Here's a word you're going to hear all semester, and that word is GAAP, G-A-A-P. Not Gap, like where you go shop for your clothes. That stands for Generally Accepted Accounting Principles. What is that? That's our rule book. So we want to remember that word. GAAP is our rule book that we use for financial accounting. Now, it's governed by a lot of different people. Let me be clear about how it's governed. So you want to pay attention to this. We've got the big dogs out there, the SEC, or the Securities Exchange Commission. These are the folks that run the organizations such as the New York Stock Exchange. They tell businesses when they can do initial public offerings to sell their stock. Those are called IPOs. They're the lead dogs in charge. They have asked the FASB to be the ones to make the rules. And they did that back when they were created back in the 1930s. The FASB, which is the Financial Accounting Standards Board, is literally 7 people that sit in Connecticut and they make the rules. To be on the Financial Accounting Standards Board, or FASB, means you are at the pinnacle of your accounting career, and it's something all of us accounting geeks aspire to. So the SEC gave the FASB the power to make the rules. Remember, the rules that the FASB makes is called GAAP. And I've got one more little acronym for you on this page, the IASB, International Accounting Standards Board. I know I've got some international students in this class, and the International Accounting Standards Board is what makes the rules for the rest of the world, right? So let me just say that again and turn the page. We have US GAAP, and then we have everybody else. Now, why do we do that? So years ago, all around the globe, every country had their own set of rules. And as we became much more of a global industry, where big companies operated around the world, we realized we couldn't compare financial statements. And so all of the countries got together, including the US, and they said, hey, let's come up with one set of rules. One, right? That would be awesome. And the U.S. said, yeah, that's awesome. We're in. And then as the rules started to get created, the U.S. was like, well, my bad. I think I'll just join up when I feel like it. And literally that was 20 years ago. So the U.S. has been making baby steps to align with the international community, but we're not there yet. What does that mean to you personally? What that means is that someday, if you decide you want to invest in a shoe company or an athletic company, and you pull up Nike and you pull up Adidas, you need to understand that Nike is going to be under US GAAP and Adidas is going to be under the IFRS or IFRS, which means when you compare those financial statements, you're looking at two different sets of rules, right? Hopefully someday we'll actually get there and be like the rest of the world. All right, so let's keep talking about accounting, what it is. So there's two key activities in financial accounting. The first thing is measurement. So let me talk about what measurement is for a minute. Measurement means I'm going to look at my company and I'm going to look at every economic event happening inside my company and decide to record it. So what's an economic event? They can be small things like maybe I made a sale to a customer. Maybe I purchased some inventory. Perhaps an economic event is just my employees showing up for work, which means I'll have to pay them later. Or economic events can be big things like Boeing. That's, the large airplane manufacturer. There were some airplane crashes last year in 2019. That's a huge economic event to Boeing. They had to sit down and think about how do we measure this, right? Some things are simple to measure, right? If I make a sale, I know how much my customer paid me. Some things are harder to measure, like, oh my goodness, there was a plane crash. This is going to be bad for my company. How do I measure it? After we've measured things, we have to communicate them, right? And remember, financial accounting means we're telling the public about what's happening inside our company. And we're going to do that through these 4 core financial statements. These 4 core are going to come up all semester long. So you'll want to kind of dig into them because this is where we start. We're going to go through each of them individually in this lecture. So let me just take a minute and pause and just say, why in the world is accounting so complex? Why do you have to take a whole class to enter the business school on it? And why do the people that become accountants and CPAs have to go through years of training and take a big, ugly test? Well, it really goes back a lot to the stock market crash in 1929. During the Great Depression, people started looking around at the stock market crash and they said, whose fault is it, right? Everybody wanted to point arrows. Oh, it's this person's fault. It's this person's fault. Congress got involved and said, you know what? If we'd had better information about these companies, we might not have had the stock market crash. So Congress created the SEC that I talked about earlier. Remember, the SEC is that big dog that rules everything that we do in the United States around equities, meaning stocks, bonds, etc. The SEC said, thanks for creating us. We're going to delegate making those rules to the FASB, the 7 dudes sitting in Connecticut. And then the FASB started making the rules. Years later, many, many years later, in the early 2000s, we had another major event here in the United States, which is where we had large companies worth billions of dollars falsify their accounting. So they falsified the records. Why do you think they did it? Money, right? They falsified them so that they looked better. In other words, they looked more profitable. That helped their stock go up and helped the people in charge make more money. Well, they got caught. And what happened was the public, again, got shaken. Their confidence in our system got shaken. And they said, how can we trust these financial statements? It's great that they're rules-based, but if people are going to lie, how can we trust them? So Congress got involved again, Senators Sarbanes and Congressman Oxley, and they created something that people lovingly call SOX. And what SOX is it actually increases accountability for executives. So meaning if the CEOs and CFOs falsify their financial statements, they can go to jail. We also created an auditor of auditors role called the PCAOB. So now This gives the accountants a lot more, I'll call it a big stick to carry that says, you can't make me make bad journal entries, because remember, we've got these SOX rules. Oh yeah, that's my dogs barking in the background. Okay, so let's remember again. FASB, 7 people in Connecticut, create the rules called GAAP, and they do it using this thing called a conceptual framework. What's a conceptual framework? Well, think of it like our Constitution, right? Our Constitution doesn't tell us every law in the country, right? But it does tell us what our guiding principles should be so that then laws can be created, right? So the conceptual framework is like our Constitution, and GAAP is similar to laws. Okay, let's talk about our core 4 financial statements. Hey, and in case you were wondering why I'm not on camera, I'm filming this during the time of the pandemic, and personal hygiene is optional at this point in the universe, so I will not go on camera. All right, core 4 financial statements. First one, income statement. Let's jump into that one. The income statement. It reports the company's revenues and expenses over an interval of time. Those are the words I want you to key into on this page. Revenues, expenses, and over an interval of time. And when I say over an interval, what I mean is maybe it's just for a month. So maybe it's just for August, right? Maybe that interval of time is a quarter of the year, which we would call 3 months. Or maybe it's for the full year, right? An income statement will never exceed 1 year. So the purpose of the income statement is to tell the readers, hey, here's all the money we made. That's our revenue. And here's all of the things that it cost us to make that money. That's our expenses. If revenues are greater than expenses, I have net income, and everybody cheers. If revenues are less than expenses, right, then it's a net loss. So let's do some examples of, actually, let me go back again. What's a revenue? All right, let's pretend like I'm Snap, right? Snap Inc. is the parent company of Snapchat. I want you to think for a second, how does Snap Inc. make money? Well, any of you guys that are on Snap know you have lots of ads. That's how they make money. That's their revenue. People pay Snap money so that their company can advertise inside Snap. That's revenue. What is an example of an expense at Snap? Well, they probably have a whole lot of people, right, coming up with all those ideas, all those filters. They probably have a lot of servers, right, holding all of that data. Those are examples of expenses, right? And we'll pick on Snap all semester long. But if we pulled up Snap's income statement today, I want you to guess for a second. Do you think revenue is greater than expense or less than expense today? Well, the answer is it's actually less than expense. Snap is running at a net loss still. Someday, hopefully, we'll see it turn around, maybe even this year. But right now, their expenses are still higher. All right, here's an example of a really simple income statement. We see revenue and we see expenses, right? In this case, it's a golf academy. So we assume that they earn their revenue through golf lessons. They have expenses, right? Here's the various types. The difference between the revenue of $7,200 less the total of expenses of $6,000 gives them net income of $1,200. An income statement is as simple as that. Now you'll notice here, we didn't just give expenses as $6,000. We gave our reader more detail. Giving reader detail can be very important in communicating how you're doing. And what we do is inside these groups, and I'll touch on this again after the balance sheet, is we use these accounts. Accounts are just more granular pieces of information inside a category. All right, next let's talk about the balance sheet. Now, whereas I told you the income statement is an interval in time, right? So let's just say, for example, January through December of 2020, I've got an income statement that's telling me all the revenues and all the expenses that I've earned inside 2020. A balance sheet is going to be at a particular date. So that means is my balance sheet would actually be at the end of that interval. So December 31st, 2020. And as we look at what's on a balance sheet, this will make more sense, but I want you to remember this. It's a point in time, okay? Now, what's on the balance sheet? Well, we talked about the income statement has what I've earned and what my expenses are. The balance sheet is about what I own and what I owe. So I'm going to skip this silly slide. I might talk about it in our live session. So, for example, assets are what I own. Okay. Now, usually they're things that I can reach out and touch for the most part. Things like cash, accounts receivable, that's money people owe me. Supplies, right? Those are paper clips and paper sitting in my supply closet. Equipment, etc. I've got total assets of $40,000. Liabilities are things that I tend to owe people or a service I still need to provide. Right? Accounts payable means I owe somebody some money for something. Salaries payable, I owe my employees some salaries. I owe the utility company some money because I've got a utility bill. A note payable is money I've borrowed from the bank or some other formal agreement. You can see in this example we have a sum of $14,000 for those. So I've got my assets, things I own, my liabilities, things I owe, and then I've got this other group down here called stockholders' equity. And stockholders' equity is something that really is how the company gets capitalized or funded, right? So think of it as what's left. If I take all my assets, I subtract my liabilities, my stockholders' equity is what is left. It can be common stock and it can be retained earnings. Now, if I add the total liabilities, this number here, $14,000, to total stockholders' equity, $26,000, notice I have $40,000. What strikes you about this? Well, hopefully what strikes you is that total assets equal total liabilities and stockholders' equity. That's called the accounting equation. This is something I always tease that if you get a tattoo of this, then that's awesome. I would get one, maybe. And I love accounting. But here's the accounting equation. Assets will always equal liabilities plus equity, no matter what. This will be our truth forever. All right, and here's another picture of the accounting equation. Assets will always equal liabilities plus stockholders' equity. Now, inside stockholders' equity, we've got a couple different components. We've got the common stock and the retained earnings. Common stock gets created when somebody invests in my company. Retained earnings is impacted by how much I'm earning and how much I'm giving back to investors. So it gets impacted by those things on the income statement, the revenues and the expenses, and then this new concept called dividends. Dividends are when me as a company decide to give my shareholder back some of those earnings, usually in the form of cash. So it's important to understand this equation at the top, assets equal liabilities plus stockholders' equity. And it's important to understand how retained earnings comes about. When I see students struggle, it's always in this. Now, if while I'm going through all of this, you're like, whoa, this is so fast and I don't understand it. Two things I want you to think about. One, maybe stop, read the chapter, then come back and watch the video again, right? Because maybe that will help. Two, you can always slow down the videos in YouTube. You can speed them up or slow them down. And actually there's a third, and the third is that in class, we're going to go over lots of examples of these things and work it together, which will help you understand these concepts. So don't freak out if you're listening to this and going, oh my Lord, excuse me for saying Lord, oh my goodness, I do not know what she's talking about. All right, so I'm going to pause here, upload this video, then I'll come back and do one more.